you all for joining us today. I am Jenny Surane. I am a reporter at Bloomberg News. I am joined by Margaret Keane, the Chief Executive Officer of Synchrony, the largest issuer of private label credit cards in the United States. She has been CEO since 2004 and led the company through its initial public offering in July of 2014 as it spun out from its former parent company, General Electric. I'm also joined by Douglas Merrill, who's the CEO of ZestFinance, which he founded in 2009 to help lenders use machine learning and data science to improve their underwriting capabilities. Before Zest, Douglas spent 5 years at Google as the company's Chief Information Officer and Vice President of Engineering. So thank you guys for joining me.
Thank you.
Really excited. So I think to kick us off, it would be great to hear a brief overview from both of you and your perspectives on artificial intelligence and underwriting and what it means to your respective companies.
You want to go first?
All right, I'll go first. So I think if you look back at the history of financial services, there have been a couple of really material inflection points. Obviously the creation of money was an inflection point, the creation of fiat currency was an inflection point, the creation of FICO was an inflection point, and I think people are going to look back at the next kind of 10 years in the future as the creation of machine learning, driven primarily by the fact that computation is now free and infinite, storage is free and infinite, and bandwidth is free and infinite. Those three drivers, I think, have led to the creation of a bunch of ML tools that are going to transform the way banks run, the way banks lend money, the way banks collect money. And so I think in 20 years, this will be the time that people will look back to wishing they'd been part of the story.
And I would just build off that to say, we've always had a tremendous amount of data. We have lots of data. And I think the real question is, how do you make use of that data in real-time decisioning, whether that's to approve a credit, authenticate a customer to make sure we're actually lending to who we say we think we're lending to, and protecting against fraud. So I think what Douglas said, having the capacity from a technology perspective to monetize that data in such a way to really use it to make those decisions quicker, faster, immediate is really the big win I think all of us are having as we think about AI and machine learning and models going forward.
Right, interesting. So inflection points, data, hitting off all of our checklist. So the CFPB has said there are nearly 26 million Americans that are credit invisible, meaning about 1 in 10 adults in the U.S. have no credit history with one of the major credit bureaus. There's another 20 million U.S. adults who have credit records that just cannot be scored. So I think I'd like to start by asking you guys, what do you think about artificial intelligence and machine learning? What do those really do to help lenders better underwrite for these customers?
Yeah, I would start with what it's allowing us to do. The way credit's been done for the last, 30 years, Douglas, right, is using credit bureaus and the credit bureau data and maybe some other things. I think what artificial intelligence and machine learning is allowing us to do is really to get a much broader perspective on consumers and looking at them in a very different way. So I think the positive of what we're doing is we're going to be able to lend more to people who were invisible in the past, because we're going to have other data that we're looking at that actually maybe tells us even better stories about that customer in terms of how they're going to perform in the long term than just using a bureau attribute, for instance. So I think that's a big transformation for us. I'd add one other point, though. When we deal in the regulatory environment, particularly in credit lending, it's really important that we're very transparent in those models on what behaviors and elements we're using in that model, because we have to really be able to articulate to a customer why they may not get approved. And we have to be very careful to make sure we're fair and transparent as we build these models out so that we don't cause other problems.
We'll definitely unpack that regulatory aspect a little bit more.
So kind of going back to how the kind of AI changes the ability to get these credit invisibles, kind of the best predictor of the future success is actually past performance, despite the fact that all brokerage agencies say it's not. Before 1950, if you wanted to get credit, you'd go to a bank and you'd sit across a mahogany desk from a man, and they were always men, and they were always men wearing blue suits and red ties, like they were issued in bank school or something. I don't know. And when you give it your application, as long as that man knew your kids from baseball or whatever, you'd probably get the loan. And that was fine as long as your kids played baseball. I fenced as a kid, right? My parent wouldn't have helped. And then two gentlemen, one named Fair and one named Isaac, figured out an amazing way, kind of automated underwriting. It changed the world. So the question is, what's the change? But like all innovations, it has a limit. And that limit is it doesn't deal well with missing data or erroneous data on the core credit bureau attributes that they use. The cool thing about machine learning is that you can use a bunch of data, as Margaret said, which allows you to, if you will, ignore or elide the data that's missing or erroneous. And it's almost as if you're mathematically rebuilding the good part of that dude behind the desk. Hopefully you can do it more broadly, you can do it more fairly, you can achieve transparency in what you did, but you're getting back a little bit of what we gave up in exchange for the power of FICO.
Interesting. Well, so maybe keeping in that vein a little bit, ZestFinance talks a lot about model explainability. So Douglas, can you actually explain what that means for us and maybe walk us through why you think it will play a big role in the future of underwriting as more and more lenders rely on artificial intelligence?
So machine learning has a lot of power. They're really good at segmenting and really good at predicting. They're just incredibly powerful. But the downside of that power is they're incredibly hard to understand. So for example, a relatively simple deep learning model can have as many as 1 million individual elements. You could understand each of those, but 1 million of them is going to take you a long time to do. And then there are some where you really need some more complicated help to understand. But ultimately, we're making a really impactful decision. We're deciding whether to lend you money or not. This has got all kinds of side effects, right? Credit is the sine qua non of modern life, and I'm making that decision about you. I owe it to you to be able to be clear on here's why I did what I did. That turns out to be hard math. And a lot of folks have claimed to have solved that mathematics problem. Very few actually have correctly. We think we have, Carnegie Mellon has, so there's a few different places that do it. But ultimately, how can I pretend to be doing a service to you if I'm making loan decisions to you and not telling you why I decided yes, why I decided no? How can I pretend to be meeting my social policy goals if I can't say, hey, no, I'm not accidentally, or on purpose, I guess, but accidentally not lending to women, or how can I treat you as a customer well enough if I can't now tell you, here's how to make you as a customer, as a bank, my customers, how do you think about what this model does and how it runs, et cetera. Without those elements, no one should spend a minute thinking about ML.
Is it something you see more lenders interested in investing in and making sure that they can do the explainability of the model? I know we heard from Margaret earlier, to your point about the adverse action and things like that. It's obviously top of mind for you guys from a regulatory perspective, but is it something you see more lenders investing in and thinking about?
For any of you who are thinking about it, feel free to find me at my booth. So, I mean, it's a little hard for me to say, and I'm a little bit working in my own interest. I believe I've had a lot of conversations with amazing financial institutions, including Margaret, who I'm privileged to have spent some time with. And I think everyone has some ML in the lab, right? And all those lab things look really good, but nobody knows how to get them out of the lab into production. So that barrier, which is what we chose to focus on, is I think the key thing, which is getting in the way of ML truly transforming financial services.
And so that the fact that sometimes it's hard to unpack an ML decision and determine, what actually yielded the yes or the no in that credit decision, that's the barrier you see keeping lenders in the sandbox, I guess, on machine learning.
So I think the kind of the slightly broader version of that, which is yes, comma, and how do I tell applicants what happened, comma, and how do I tell regulators what's going to happen, comma, and how do I tell my internal operations folks and internal audit folks what's going to happen, all building upon your point, but you end up with a few different use cases that you have to manage.
Gotcha. Well, maybe we can dig into the technology a little bit more. So when you guys are thinking about incorporating AI into your underwriting, what does this really mean from a business practices perspective? Or in Zest's case, helping a lender incorporate that into underwriting? Is it using more of the data that you already have? Is it finding new sources of data? How does it allow you to price and assess risk better? Really dig into the business practices for me.
Yeah, so I think it's really three things that you're looking at. And you have to start with the infrastructure to be able to take all that data in. So that's really important. So you have to make sure you've built your systems in a AI fashion that allows you to absorb all that information inside. So you really want to do three things. One, we have a ton of data. So you want to be more effective at using the data you have. Second is you want to maybe partner with other folks. So in our case, we work with our partners where they may share data about their customers that they know that we wouldn't know. So an example of that could be we're doing an online approval of somebody. They pass us back information that says, yes, we've shipped to this address before. So that's like a great fraud, good thing for us to know, because we can feel more comfortable approving that account. And, if they're buying a big screen TV online, you want to make sure you're delivering it to the right place. And then the third is really what I would call third-party data. So is there other data out there? And, one of the examples I'll use is, we've partnered with Payphone, who actually leverages information off of the cell phone databases. And believe it or not, people are really, really into their cell phones, and they keep their data really current. And it's been two things we're using it for. One is to pre-fill applications, so we get more accuracy in the pre-fill of the application. But it's another great authentication opportunity for us to really make sure the person who says they're applying is really the person applying. So I think what you really want to do in this world, in this new world of all these things, is you want to do 1 + 1 = 3. So I think you have to really think about how you're partnering, who you're partnering with. You got to gain trust with each other. You have to have good open dialogue about what are the challenges and work it through together, which I think Zest has done a really good job on, because I think when we first met, there was a lot of discussion about regulatory, and I think Douglas took it very seriously and actually is making it sounds like a competitive advantage for his company now.
Thank you. That's kind of you. So I would pick up one thread of what Margaret just said and pull on it a little bit. It's often the case that our clients have a lot of data internally that they're not using. They may not be using it because it doesn't seem on the surface relevant, but more often they're not using it because it's just hard to do in the underwriting framework that they've got. But some of those things are relatively easy to do in our framework. Let me give you a completely trivial example, which I could manage in an old infrastructure as well, but let's work with it. So almost all lenders have bankruptcy yes or no in their models. Some actually select positively towards people who have bankruptcy, and some select negatively, but almost everyone's got it in their market. But what's interesting is in the US, you can do first order, declare bankruptcy once every 7 years. So a bankruptcy that's 7 years ago is actually a very different risk than one that's 2 years ago, particularly if you overlay on that cash flow and sale movements. You can actually get a picture where it materially matters when that default happened, when the bankruptcy happened, and what their movement is since then. So there's a little bit of a dynamic component, and that's data everyone's got. I mean, that comes from the bureaus. I mean, everyone's got that. And then there's sort of other stuff which is lying around that's more special. So, for example, customer service data, et cetera. All of which, if you can find a way to unlock it, has incredible value. Just most places can't unlock it.
I see. So it sounds like the focus is maybe using a lot of the existing data that you guys already have, just in a new way.
Well, and making it more real time.
Yeah.
Because I think we had a lot of data that's stagnant, and maybe we pull at it once in a while. But what you're trying to do in the models that you create, they're almost, I call them living beings. You're constantly adding new data to, this is my terminology, not a technology one.
Something that sound like little lobsters.
Yeah, little beings, where you're constantly updating the data that goes into the model, and you're refreshing your models on a constant basis. Where in the past, we'd develop a model, we'd pilot the model, we'd get it out there. Maybe it'd take 12 months to get a model out. Then maybe we'd start doing a new model. Today, what we're doing using AI and machine learning is we're updating models with new information, new data on a constant basis, and getting smarter and smarter at how to make these credit decisions, and also authenticating and really managing fraud.
That's cool. So there's one sort of interesting thing about the capability of ML models to learn very quickly, is that just the mathematics of ML models is inherently unsteady. The beauty of logistic regression is it's really simple and it's really steady. Like, it doesn't tweak on its own, it just hangs out. Many ML models will sort of resonate within themselves, and you kind of don't know that. And so they try to learn stuff, they try to get smarter, and they end up, in general, moving in a good way, but every now and again, they're not smart enough to know they've just reached a cliff and fallen off. So one of the most interesting is fine, things one has to do with ML models is wrap them in this sort of complicated monitoring, so you can hopefully notice before they fall off the cliff, but benefit from the really fast learning, because you get, it's sort of you're balancing on the edge of a knife.
I see. So maybe getting back to that idea of what business practices really have to change at banks.
Neither of us answered that question.
No, the answers I think so far have been super interesting. But is it? It sounds like maybe there's a little bit of a tech build, right? If to be able to react to the data and pull it in real time, but also a new way of thinking about some of the data that we're sitting on.
I think it's a cultural shift too.
Yeah.
You need to really hire people in who have that background to really be able to developed the models are comfortable on the technology side to really leverage the technology that's available to them. And then I think it's a new way of doing things. So when you're shifting to something like this, where before I would say, we did a model, it took 12 months, we were very slow, the pace of change is very fast now. And you need to make sure you have the right infrastructure, the right oversight, so you have the right people looking at what's being happened, making sure you're monitoring the output. So it's really a whole ecosystem of credit underwriting that I think is dramatically shifting, and you have to look at it from all aspects of the company: talent, technology, oversight, regulation, and actually bring the organization along as you're making this transformation.
For sure.
From a talent perspective, is it easy to convince AI and machine learning guys to come work for a bank?
Oh, are you saying we're boring?
I would never. I would never.
We're not boring at Synchrony.
You guys aren't.
Now, maybe other banks, but not this
Let's talk
one.
about the rest of it.
No, we're not. I think it's still a moving field, and I think it's morphing. So there are a lot of people who say they're AI experts. I'm not so sure they're all. I'd say he's an expert, but there's not many experts out there. I think we're developing the talent internally. I mean, one thing we've done is we've partnered with universities, which has really been positive for us. So we've partnered with the University of Illinois, the University of UConn, where we're actually developing with students there, from PhDs down to undergrads, working on a lot of the things we're talking about, and then they come on to our company as they learn more about us. So it's been a great way to pull talent in. Obviously, we still have to go outside and hire talent. We've not had a huge problem yet, so we're still not viewed as a boring bank yet. So
I guess it could be fun if you're a tech guy, to get a crack at the world's largest or the country's largest private label credit card issuer. You got real customers that you're solving for. It's kind of interesting.
But I think it's more about the culture.
Yeah.
Right. You want people to come into a company who is innovative, and if you give them good, challenging work, and they like the environment they're working, guess what? They'll come and work for you. You got to really have that right, that formula right, to really get the talent to come in and stay.
Yeah.
So oftentimes in our arrangements, we end up helping build the client's modeling team. We do that by sometimes helping hire, although that's not really kind of what we're necessarily good at, and I think internal hiring functions are far better than that. But we do a lot of training, we do a lot of monitoring and some help like that. The cool thing is that there are increasing numbers of people who understand how to do ML. There are not increasing numbers of people yet who I think are kind of broad-ranging experts, and you need a couple of those lying around to get the organizational change that Margaret just described. So we're still not quite there for the talent front, as you can see from the prices that AI people are able to command in the market. But I think we're moving in that direction.
Okay. Well, maybe switching gears just a tad. So for private label and co-brand credit cards, we're talking about decisions made at the point of sale. And so, Margaret, I know you talk a lot about making that process as seamless and as frictionless as possible. So how does artificial intelligence play? Like, how does it allow you to work with retailers to actually improve that customer experience?
Yeah, it starts really at the application process. So I think what's really important, I think a lot of times we talk about mobile and digital, but what we really have to think about is the whole ecosystem of retail is changing. So even inside brick and mortar, people are using iPads and iPhones walking around, and that becomes the point of sale. So what we have to really make sure we're doing is continually enhancing our technology footprint using AI and other things to make sure we're moving fast enough to make that process really easy. And as you said, in most cases, people are buying something and then they're getting offered credit to purchase that item. We don't want to be the person who's in the way of that purchase. We want that purchase to be as frictionless as possible. So using things like I said earlier, payphone, for example, where we pre-fill the app. Customer only has to put in 2-3 little pieces of information. Boom, they have the answer. Then the other big piece is really ensuring from a partner perspective that we're not creating some kind of fraud issue in that environment, right? So we know who you are, we're giving you that product, it's the right person. So using technology in that perspective of making it fast, making it seamless. And then on the back end, I'd say, and we're beginning to work on this, there's 2 other areas I'd focus on is we want to make sure that customers have access really quickly to our customer service. So using Sydney as our virtual assistant to really help customers. I tell people all the time, I always ask, how many of you like calling an 800 number? Nobody raises their hand in the room. But if you can get your answers through a chat bot and get what you need on and off really quick using your phone, that's great. We also want to be able, when they're in the store environment, for instance, being able to give customer a credit line increase. If they're looking at purchasing, they only know they have this much, can I use my mobile phone? So using the mobile phone right there to ask for a credit line increase. So really looking at the whole experience of the customer to really drive that frictionless experience from beginning to end.
So if let me just pull on one thing. Obviously, we're not a white label credit card provider, but one of our clients had about a 30-element long application process for relatively kind of smallish loans, and they had a really bad fraud problem. So we were able to use kind of some of their own data, some third-party data, to get it down to a 4-element application and reduce their fraud by almost 60%, because there's just good data out there, and if you do it in the middle of the flow, all of a sudden good things happen.
Right, and fraudsters usually will spend the time to fill out 30 elements.
I wouldn't.
Right, most other people won't.
Yeah.
So that's an important element. It's right. It's a red flag.
Let's maybe dig into the regulatory landscape a little bit more. I know we've touched on it some, but I know that's something that you both care a lot about. So there are regulations around, like we've talked about, providing customers with that adverse action notice if they're denied credit. So what types of, and also what types of data that lenders can rely on when making an underwriting decision. And so I'm hoping you guys can walk me through what types of AI technologies of today really help you navigate that regulatory landscape.
Why don't you start? Because you've been having big regulatory meetings, I understand.
I've been spending a lot of time on regulators. So the shorter answer is, without perfect explainability, no one should be using ML anywhere in their process, because you're gonna have a FCRA violation. So the particular thing that you were talking about with adverse action is FCRA, and it's extremely complicated. And one may argue that it's implemented good or for ill, but the social policy goal is clearly to help people understand what bad thing just happened to them and how they can improve it. And so the policy goal seems like a pretty good thing to do. The tricky part is you actually have to do things a certain way to be able to explain an ML algorithm. And what we've been spending a lot of time talking to regulators about is there's a bunch of stuff that's come out in the media about how to do explainability. Actually, it all doesn't work. And so we want to spend a little bit of time with the various mostly 3-letter agencies in DC, talking about how would you know if the methodology you're looking at works? How would you know if it doesn't work? Not because I'm necessarily trying to sell a product, but rather I would like to make sure we don't accidentally harm customers. And I think on the current path, we're going to accidentally harm customers.
And I would just agree with everything he said. I think, one, regulators come in and check our models. They actually look at them and they'll test them. They want to make sure we're not doing something that is off base. So we have to be sure that as we're moving very quickly in this new world of technology and using AI, we have to make sure we're bringing the regulators along with us and being very clear and transparent with them, explaining what we're doing, how it works, kind of bringing them in the tent, if you will, and really ensuring that they understand and we understand and we're all aligned. Because, the reality is, I know everyone gets sometimes nervous about regulators. The goal here for all of us is to be fair and transparent to consumers, and we should all be doing the right thing. So, partnering with the regulator and having those discussions versus saying, well, we're not going to talk to them and we're going to just do our thing over here is silly. They have a job to do. We have a job to do. We should both be on the same page, particularly when it comes to customer protection. And, I think you'll all win if you do that the right way.
And have you guys found, I guess, that regulators have an appetite to really, I guess, learn about model explainability and have a vested interest in coming along on that ride?
Yeah, I think the regulators in general are very open to fintech. They're open to what's going on. They want to understand it. They don't always understand everything, and that's where I think we have a role to play to help them understand it. And where Douglas was saying he was down with some of the regulators in Washington, D.C., I think that's really good because it's going to help them move forward too. And then they're not going to feel like they're in the dark, and then they're not going to think you're doing something nefarious, right? If you're partnering with them as you build these things and develop new technologies and new ways of underwriting.
Yeah. And I guess they, it's kind of interesting because I assume that a lot of the regulators, they like the idea of kind of bringing it back to where we were at the beginning, that this could bring more people into the financial system and some of those credit invisibles that we talked about at the beginning.
Yeah, well, they want you to bring more people in, and they want to make sure you're bringing people in who can afford to pay you back.
Yeah.
So anything we do to enhance that process is a good thing for a regulator, because from a safety and soundness perspective as an institution, that's really what they're looking at, right? Are you making sound credit decisions, good judgment? And so once we can demonstrate to them that we've actually gotten better at this, or we're decreasing fraud, we're doing better authentications, and the numbers show that, and you can demonstrate that with the model, it's really a win-win.
Well, I know we have a few minutes left, so maybe as our parting words, we're in a room today filled with bankers and fintech employees. So what are some parting words that you guys can share with this audience in terms of the importance of these two worlds, fintech and banking, working together to further incorporate artificial intelligence into their underwriting models?
Well, look, I'm a big supporter of this whole arena. I think that my concept of 1 + 1 = 3 is really important.
Although terrifying mathematically.
I know. But really getting to a point where you're taking the best of both worlds and bringing them together to come to a better solution for your consumers and your customers. And also figuring out ways where maybe there's faster ways to doing it than just doing it yourself. And I think by bringing in and partnering with various fintechs to help you come up with better solutions for your customers is really a good thing. So, we're big on doing that, and we'll continue to be partnering with folks in the fintech world.
Yeah.
So in the early 1990s, I was a consultant, and a bunch of folks kind of wandered around saying, oh, by 2000, the word bank will only be a verb. It will no longer be a noun. The notion being that banks would have become virtual entities, and all you would be I'd be going to bank, do something. Right? I'm going to get cash as opposed to going to the bank. That was wrong, clearly. Not even remotely correct. To be clear. But something has changed in the last sort of 5, maybe 10 years, and that is that we've all found ways to have less disdain for each other, which has allowed us to talk to each other. I mean, I think for a long time, kind of old world financial institutions looked at startup companies as kind of the Wild West and unlikely to be like kind of a negative thing. And I think for a long time, people in Silicon Valley looked at banks as dinosaurs. And actually, the truth is, I don't know, maybe our companies are a little, Wild West sometimes, and there probably are some banks that are dinosaurs, but actually, by and large, we each add value to the other in such a hugely material fashion that, I think it's a little silly to view any world in the future other than fintechs and banks all working together to do what they're each good at.
I think that's a very interesting way of looking at it. No animosity here on this stage, I suppose.
No animosity.
Well, thank you guys so much. This was really enlightening. So, Margaret Keane, CEO of Synchrony Financial, Douglas Merrill, CEO of ZestFinance. Thank you guys very much.
Thank you.
As we go this way, walk carefully there.
Thank you again, everyone, for that session and that panel. We're going to take another 10-minute break, and afterwards, we're going to pick up where these guys left off. And we're going to talk about regulation and talk about RegTech. So join us back here in 10 minutes, and we're going to start off with the RegTech panel that's going to finish out our track for the afternoon.